Hello, I'm Tag.
And this is Bob.
And you're listening to Bob and Tag Talk. Before we start the show, I'd like to point out that the topics discussed on Bob and Tag Talk are for informational purposes only. So please don't take this as investment advice. We urge you to do your own research before making any investment. So today we're going to talk about the rules of investing as described by John Bogle.
So John Bogle is a very famous founder of Vanguard.
Mm-hmm.
So Vanguard is actually one of the first companies that started in mutual funds and then index funds.
Mm-hmm.
And John Bogle has written a lot of books about his journey on how he started his career in the mutual fund industry and then how he created the first index funds.
Mm-hmm.
Then again, he's written a lot of investing books as well.
Okay, I think before we continue, we'll just give a brief explanation of what you mean by an index fund, because he's written books about index funds.
Index fund is just basically we're just tracking the index, any
Right.
index. It could be the S&P 500,
Mm-hmm.
it could be the Nifty 50, or it could be the Dow Jones. It could be any index.
Right. And for those who do not know what a market index is, we recently put up a blog called Market Indexes in India, which explains exactly what an index is. So moving on to the rules of investing, what are some of the rules that he prescribes in his book, John Bogle?
So the first rule that he prescribes is called the reversion to mean.
Mm-hmm.
So if we take like a normal standard, any kind of income producing bond, so if we track it in a graph, it'll compound smoothly.
Mm-hmm.
It'll appreciate over time,
Mm.
and it is like a upwards sloping graph.
Right.
So that is like bond is like it gives like compounded income at a significant. I mean, at a certain set of period.
And it's sort of like stable in a way.
It's kind of stable.
Okay.
But when we move to volatile kind of assets or volatile stocks,
Mm.
so it'll always be fluctuating. There's a lot of volatility in the market.
Mm.
So eventually, the most of the point that we do is we can do dollar cost averaging. So what we get out of dollar cost averaging is we try to best volatility. So as the prices go beyond that particular the mean line,
Mm.
so it becomes expensive. As it goes below the trough, it becomes cheaper.
Okay.
So this is the part. Eventually, at any point of time, it will actually revert to the mean. It will always draw towards the mean.
Okay.
So if it goes too high, it will try to come down. If it goes too low, it will try to come up.
Okay.
So this is something very important to understand, and it's up to us to make sure that we don't overpay, and then we try to get as cheap as possible, and dollar cost averaging will take care of that.
So dollar cost averaging is a type of tool that tells you how.
So dollar cost averaging is investing monthly, like systematic investment plan.
Okay. And when you invest in a volatile asset or whatever it is, you usually see crests and troughs in the graphs. And so reversion to mean says that regardless of where the stock price is at right now, it'll eventually revert to the mean value of the crest and the trough.
Intrinsic value, yeah.
Okay. So how does that help us? How does this rule help us with investing better?
It will enable. I mean, make sure that we are understanding the concept of what exactly the intrinsic value is, and then we can actually plan ahead.
So is it something like we know exactly how undervalued or overvalued?
That is very difficult. We can only say that it will always revert eventually.
Okay. So what are some other rules of investing?
So again, some of the other things that actually they talk in the book is about to give a long time duration for any kind of an investment. As we have a longer term duration, generally we'll overcome volatility, and then it will not matter in the long run.
Right. Yeah, I think with a lot of our investments, people usually say make it for the long term, because you obviously get better returns, and like you said, volatility is sort of, I guess, volatility averages out. Is the term.
And as time goes on, the compounding value also increases.
Right.
The longer time horizon we have, if you see the compounding value after 10 years and after 30 years, there is a lot of difference.
Okay. So number one, reversion to mean. Another one, make your investments for the longer term, as long term as possible.
Yeah. And the other thing is we should also take care of we should not do impulse buying or impulse selling.
Okay.
We should make sure that we are not reacting to what the market prices are. We should just stick to our plan and just continue to do what we do as time goes on.
Yeah, regardless of any turbulences we encounter or people who say that, oh, this stock is doing well, not doing well, etc., etc. Okay. What else?
The other thing is to forget the needle and buy the haystack.
Okay.
So this particular rule is mainly about diversification. So instead of trying to look for that one particular stock or one single company that you want to invest in, why don't you just buy the whole market? So eventually the index, that's the whole concept of the index fund. The index was basically depending on the GDP of that particular country, it will always go up over time. So instead of trying to speculate over one particular stock or try to overanalyze on one stock, you can just buy that particular market and it will eventually, you're diversified, you're properly diversified, you're basically hedging your downside, and then in the longer run you'll always get the best out of whatever the market gives you.
Right. So you diversify based on what you see on the index, or am I misunderstanding?
The index fund is about collection of stocks that there. So when you invest in it, you're automatically diversified.
Okay, fine. So basically diversify to reduce the
risks. Yeah, it is basically your risk and volatility as well.
Okay. What else?
Then the other thing is to minimize their expenses. So basically we have to analyze, like for example, whichever investment product that we are going to choose. Either it's going to be mutual fund, it's going to be a stock, either through one of the stock trading apps or any of the banking financial applications, or it's even if it's a bond. So what we have to make sure of is what are the different charges that are applied.
Right.
So you see, is there a charge when you're going to do an investment? Is there an initial load? If you want to withdraw your money, is there an exit load?
Right.
So is there an annualized charges or something like that?
Okay.
And then is there any kind of an expense ratio for that particular fund? And then let's say if you're trading too much, sometimes you pay trading charges. Whenever you're trying to sell, the trading app will take a cut of it. So a particular percentage is deducted. So all these charges will have to make sure that you are monitoring it, and you're paying as less as possible.
Right.
So index funds already take care of that. The expense ratio of the index funds are very, very much lower, but ETFs are much lower than index funds. But the only drawback is that in ETFs it is tradable. So sometimes when you make trades, there may be additional charges. But in index fund, generally you cannot trade it. Buy or sell, there is no initial load and exit load.
Okay.
So those kind of charges are actually minimized.
Right.
And then these when you over the long term, if you invest, these charges don't compound and they don't reduce your returns.
Okay. Got it. So what's next? What other rules does Bogle prescribe?
So the other thing is to assess the risk. So at any investment product that we choose, we should always analyze the risk of it. For example, what is the risk in investing in a bond? Which company which we choose for a bond, then what are the different risks that the bond rating, what is the bond rating, what is the time period and everything we have to be aware of.
Right.
And there are also bond index funds. If you don't want to invest in a specific company bond, you can always go for a bond index fund, and that also diversifies your risk.
I suppose it is prudent to identify what are all the different types of risks associated with an asset. No, it's not just about the risk of buying the asset. It's about the risk of investing in that particular company and seeing if they are doing good, if they'll do good for the long term. So it's not just about researching the bond, but it's also about the company behind it and all of that.
The company behind it. When it comes to mutual funds, generally the mutual fund companies will actually decide what are the different risks in mutual funds. So this mutual fund come into, are they investing too much in equity? Are they investing in bonds? Are they Do they have cash, and is it really stable? Is the management really good? Those kind of, there are always risks everywhere. It's just that we need to be aware of all these kind of risks.
Right.
And when it comes to stocks, there are more different risks to be aware about.
Okay.
The thing is, if we are really looking for any return without taking any risk, we will not be able to get any return.
Okay.
So there are risks, and you have to be aware of what is the risk that you are comfortable with.
Okay.
And then you make sure that once you decide and then you take the risk, you have to stick to the plan and just be follow through with your plan.
Got it. So yeah, there's no escaping risk, but you just have to figure out, okay, if you're okay with the risk you're taking. So to be okay with the risk you're taking, you need to know what risk you're taking. Yeah, okay, makes sense. That makes a lot of sense. What else?
And one of the other parables is really the hedgehog beats the fox. So this is mainly about Bogle really talks about simplicity over complexity.
Okay.
So for example, one of his main things is, again, when it comes to any investment product like mutual fund, the mutual funds are different: strategic mutual funds, thematic mutual funds, and then there are also like kind of strategy mutual funds, and then there are index funds. So when you compare all these, index funds are the most simple ones. It's easy to understand. You know exactly what you're getting. With all the other things, you really have to. There are different types of risks involved, and the products become more complex to understand.
Right.
And then some of the complexity also increases or decreases, increases, the volatility, or sometimes it decreases the return that we get over time.
Okay.
So we have to be aware of those things. So whenever you are, faced with confusion or conflict, you always go for the simplest products. Even when it comes to identifying stocks, also try to go for the stocks which have real simple business outlook, business strategies, and so on. So all the rules that we visited now, like reversion to mean, time is your friend, or forget the needle by the haystack, then minimize the croupier's stake, there is no escaping risk, and hedgehog beats the fox. All these rules are related to the kind of how we identify risks, what are the knowledge that we have with the products, what is the knowledge that we have with expenses, and what is the knowledge that we have about general investment track, how it actually goes.
Okay.
So, but now the rules that we are going to see now are a little bit different. It's more about the behavior of the investor, or more about the psychology of the investor. So Bogle also says that we have to be really, really careful on how we basically react to any kind of market announcement, or any kind of euphoria, or is there a fear in the market. So we have to train ourselves to not react to it, and then we have to stick basically to our plan. And then it's not easy to do. This is something that is very difficult to practice, but as time goes on, it will be much more easier. So one of the main thing is buy right and hold tight. So the first thing is, like, make sure that you do all your analysis before buying. Once you make sure that this is the right plan for you, and then the next part is just to hold on to this plan. Whatever it is, whatever comes, just stick to the same plan and just don't change it. Because most of the things with the trading plans is that in some scenarios, in some economic situations, in some market scenarios, some plans will do well, and other times it will not do well. So this also happens with mutual funds. So when we see with the different types of mutual funds, some thematic mutual funds do really well in 1 year. And probably in the last 3 years, if you see this particular thematic, it's totally based on oil, or it is totally based on software, it really does well. So there is no guarantee that this will continue. So if you plan, let's say your plan was not that, your plan was different, you want to switch into that is something that you should not do, because you never know what the future returns is going to be. So whatever your plan that you had chosen and that you opted for, you should always stick to it. And you should hold on to your plan.
So first, probably like do your best analysis, and then choose the plan, and then stick to the plan, even with all the turbulences and disturbances you encounter. Okay, got it.
And the next one is mainly about expectations of an investor. So basically, what is your reason for investing, and what are your expectations out of it? So generally, like, depends on how much risk you're willing to take and how much returns are you expecting. So even with something like stocks, so it is not always practical that any kind of mutual fund or stock will give more than 10% return consistently over time. So there are always ups and downs. So maybe for 3 or 4 years you may not have, you will always have negative returns.
Right.
Then suddenly 1 year it will just have more than 50% or 100% returns.
Yeah.
So the volatility is always there. The same thing with bonds as well. So if the company is not performing well or something like that, then the bond is not really popular and the value may really reduce. But at the same time, maybe it is not highly rated or something like that. But whatever it is, we have to have realistic expectations. On an average, let's say we have generally the expected returns of stocks is your inflation rate and the growth of a particular country. So if you take that could be the general expectation return of a particular stock. So if the inflation is 5% and the GDP is growing at about 5%, then 10% is an average return that we can expect over a longer period of time.
Okay.
But some years it will be higher, some years it will be lower.
Right.
That is always there.
Right.
But we cannot go into investing in stocks that will consistently get 25% over time. That is really difficult.
Yeah, have realistic expectations. Okay.
And some other behavior is like over analysis of history. So it is termed as beware of fighting the last war. So generally what we do is we see the historical trends of any particular investment product. What happened in the last 10 years, what happened in the last 20 years, and so on.
Right.
So these kind of historical analysis, or sometimes even can go longer back, like in the last 40 years, like in the last interest rate hike scenario, in the last time when there was a war, like which products did well, which companies did well.
Right.
And there is no guarantee. It's good to analyze those things and good to understand those kind of implications in a macroeconomic scenario. But when it comes to choosing a particular investment or something like that, you still have to take the current scenario into only the current scenario and the current market scenario, current situations, and the current companies that are there. Some of the companies that were there 40 years ago would have already become large companies, or it will not be there at all. So those industries may have been gone down, and there will be newer industries today like technology, which is not there 40 years ago. And so there are a lot of changes always.
So basically you can't just map a past scenario to the current scenario, because there are so many other small factors that have changed. And
generally there is a trend. The trend will always be there, but there will never be 100% accurate. It will not be the same thing repeat over. Generally history doesn't repeat, but it rhymes. That's the proverb. So, and it's very important that we don't get into kind of a behavioral thing where we are totally dependent on this past hypothesis. So we have to make sure that our hypothesis is current, and it's based on the current
it's supplemented by the past hypothesis.
The behavior and then how people invested, how people survived those kind of scenarios. That is important to take in, but not exactly the actual products and so on.
Got it. The trajectory of how the prices went up and down and all of that. Okay, got it. So beware of fighting the last war. That is okay. Understood.
And the main thing is to staying the course. So basically, the investing is mainly about mastering emotions. So there are different emotions like greed, fear, and then there are envy and so on. Like if someone else is doing a different kind of investment is doing really well, it does not mean that you change from your style to their style. And these kind of changes, and let's say there are people investing too much in kind of software stocks or some particular stocks, you should not change from your plan to their plan. So whatever your plan is, whatever your risk is, once you're diversified, you just stick to your plan and stay the course, because in one particular market scenario, in one particular decade, there will be one trading strategy or investment strategy that will really do well. In the next decade, it will completely change. And it is constantly changing. So probably the market cycle has been going faster and faster in the last 3 or 4 years. So some of the strategies don't even work beyond 3 years. It's constantly changing and constantly evolving. And we cannot sometimes keep up with that. It's better to see that what we are comfortable with, and we just stick to it, and then let's say we hold on to our investments and stay the course for at least 20 years. That's like 20 years is like not long term at all actually. When it comes to when it comes to retirement planning and all.
Okay.
Generally, people who do retirement planning, they do 30-year plans or 35-year plans and so on.
Right.
So that is when we actually get the true outcome of compounding, really, really high returns. So, and 10 years maybe, okay, yeah, it's kind of a medium-term planning, or 20-year, it's a medium-term planning. So as when you just stay the course and just elongate your timeline as much as possible.
Got it. Staying the course. Okay. So I'll probably just do a recap of what we've discussed today. So we've discussed about the rules for investing that you can consider following, that is good to keep in mind. So one is reversion to mean, that the prices will always revert back to the mean level irrespective of the crests and troughs. And then the second one we talked about was time is your friend. That is, make sure that your investments are as long term as possible, and then don't give in to impulse buying, impulse selling. And then forget the needle by the haystack is essentially about diversifying as much as possible to make sure you
get the market benefits.
You reap the market benefits, yes. And then I think the next one was minimizing the croupier stake, which is about knowing what are all the extra charges that come with investing in a fund or a stock or whatever it is, and minimizing those expenses as much as possible. And then the next one is there's no escaping risk. So it's very important to know what your risks are, but and to minimize the risks as much as possible. But there is no way to escape the risk. So might as well know what you're getting into before you get into it. And then hedgehog beats the fox is
simplicity over complexity.
Simplicity over complexity. I forgot that one. Okay. Simple enough to understand. And then the rest of it are behavioral sort of rules where you buy right and hold tight. Basically, you
choose your right strategy.
You make your plan and you stick to your plan, and then have realistic expectations. You can't expect the stock to rise like 30% or whatever it is. It's gonna rise and fall, and you have to bear with the rise and falls. And beware of fighting the last war. I think it is about making sure you listen to what is there in history, what we've learned from history, but not taking it basically taking it with a grain of salt, in a sense.
Not even taking it with a grain of salt. It's mostly like the old strategies will not work now. So strategy is not important. The behavior is important.
Right. Okay. How people got through those periods are more important than the products and their rises and falls. Okay. And then the last one is about staying the course. It's still about not giving in to people and their other people's emotions.
Your emotions, other people's emotions, market emotions.
So staying the course as much as possible. All right. So that's been Rules of Investing by John Bogle, and I think that's a good spot to end it there today. Hey, thanks for listening to Bob and Tag Talk. Please consider following us on our Instagram and Facebook pages. We put out weekly summaries of the topics discussed on the podcast. And if you found this episode informative, please like, share, and subscribe.